Imagine you finally find it. The house you've been dreaming about. It's in the perfect school district. The backyard is exactly what you wanted, and miraculously, it's within your price range. Your heart is racing. You call the listing agent to make an offer, and they ask you one simple question. Do you have your pre-approval letter? You hesitate. You don't. You tell them you'll have it by Monday. But by Saturday night, that house is gone. Sold to someone who had their paperwork ready before they even stepped inside. In the 2026 U.S. housing market, a pre-approval letter isn't just a piece of paper. It is your golden ticket. Without it, you're just a tourist. With it, you're a serious hunter. But here is the catch. Most people think a pre-approval is just a bank saying yes. They couldn't be more wrong. At the Mortgage Trap, we look at the reality behind the curtain. A pre-approval is an invasive, surgical, and deep look into your entire financial soul. If you don't know the rules of this high-stakes game, one single misplaced document or one unexplained bank deposit can get your application tossed in the trash. Today, I'm going to show you the exact blueprint lenders use to judge you. We'll cover the difference between pre-qualified and pre-approved, the 4 C's of lending, and the 5 common traps that can kill your approval even after the bank says yes. The dangerous confusion, pre-qualified versus pre-approved. The first mistake most buyers make is using these two terms interchangeably. If you walk into a negotiation with a pre-qualification, you're walking in weak. Pre-qualification is basically a first date. You tell the bank how much you make and how much you owe. They take your word for it, do a soft credit check, and give you a verbal maybe. It's an estimate, and in a competitive market, it's worth as much as a napkin. Lenders love handing these out because they take 5 minutes, but they mean nothing when you are competing against 20 other offers. Pre-approval is the marriage proposal. The bank has seen your tax returns, verified your employment with your boss, pulled your full tri-merge credit report, and put their reputation on the line with a written commitment. This is the stage where the bank actually commits to lending you hundreds of thousands of dollars. On one side of the verification wall is what you say. On the other is what you can prove. In 2026, sellers only care about what you can prove. If you want to be taken seriously, you must go through the full verified pre-approval process. The Underwriter's Bible, the 4 C's of lending. Once you submit your application, it lands on the desk of a person called an underwriter. This person's entire job is to find a reason to say no. They aren't there to help you. They are there to protect the bank's money. They judge your life based on what the industry calls the 4 C's. 1. Capacity. This is your ability to pay. They look at your DTI, debt-to-income ratio. They want to see that your new mortgage plus your car and student loans don't eat up too much of your gross income. Even if you feel you can afford it, the underwriter's math is the only thing that matters. 2. Capital. Do you have skin in the game? They aren't just looking for the down payment, they're looking for reserves. If you lose your job the day after you buy the house, can you still pay the mortgage for 3 to 6 months? They want to see liquidity in your accounts. 3. Collateral. This is the house itself. The bank won't lend you $500,000 for a house that is only worth $400,000. The asset must protect the loan. 4. Credit. This is your financial reputation. It tells the bank if you are a person of your word. They look for patterns. Do you pay on time or do you have a history of sliding? These 4 factors must perfectly balance for that approved stamp to hit your file. The paperwork nightmare. What the bank actually sees. The bank is going to ask for documents you haven't thought about in years. In the digital age, mostly complete is the same as incomplete. You need your financial blueprint ready to go. Income verification. You'll need the last 2 years of W-2s and federal tax returns. If you're self-employed, get ready. They will want a year-to-date profit and loss statement and will scrutinize every expense you've ever claimed. The asset audit. They want the last 60 days of bank statements, every single page. Even the last page that says, "This page intentionally left blank." If you leave it out, the underwriter will assume you're hiding a secret debt or a suspicious transfer on that page. The gift problem. In the US, if your parents are helping with the down payment, you can't just move the money. You need a signed gift letter stating it's not a loan. The bank needs to see the money move from their account to yours, documented every step of the way. Beware of mattress money, cash you've been saving under your bed. This is a lender's worst nightmare. If they can't source where that money came from, they cannot use it toward your purchase. Desktop underwriting, DU, and the secret algorithms. Before a human even looks at your file, it goes through a computer system called Desktop Underwriter, DU, or Loan Product Advisor, LPA. These are the algorithms of Fannie Mae and Freddie Mac. The computer looks at your credit, your DTI, and your loan-to-value ratio in seconds. If the computer gives an approve/eligible status, you're 80% there. But if the computer flags your file, a human underwriter will have to dig even deeper into your history. This is why cleaning up your small debts before the computer sees your file is vital. One small $200 credit card balance can sometimes be the difference between an instant yes and a manual review that takes weeks and risks your deal falling through. The silent killers, mistakes, after the approval. This is the most critical part of this guide. You have the pre-approval letter. You're under contract. You think you're safe. You are not. The bank will pull your credit again 24 to 48 hours before you close on the house. This is where the closing day graveyard comes in. The new car trap. You buy a new car to put in your new garage? Your DTI changes and the bank cancels the loan on the spot. The furniture mistake. You buy $10,000 of furniture on credit at 0% interest. Even if you don't pay today, that new monthly debt obligation can kill your approval. The career pivot. You decide to quit your corporate job to become a freelancer or start a business? The bank needs 2 years of history for self-employment. The deal is dead. Large deposits. Moving large chunks of money between accounts without a paper trail can trigger an investigation that delays or stops your closing. From the moment you apply until the moment you have the keys, your financial life must stay in a deep freeze. Do not change anything. The expiration date, the 90-day clock. A pre-approval letter isn't a permanent pass. It usually expires every 60 to 90 days. Why? Because interest rates change, and your financial situation can change. If you don't find a house within that window, you have to do the paperwork nightmare all over again. You'll need to provide your most recent pay stubs and updated bank statements. At the mortgage trap, we see people get frustrated by this, but you have to stay organized. If you are serious about hunting, you need to keep your financial blueprint folder updated every single month so you can refresh that letter in 24 hours. The psychological game of the lender. Lenders want you to feel like you've been chosen, but remember, you are a customer buying a very expensive product. Sometimes lenders will pre-approve you for a much higher amount than you actually should spend. They want you to take the biggest loan possible because they make more money on interest. Just because the bank says you are qualified for $700,000 doesn't mean you can actually afford the lifestyle that comes with it. Use the strategies we've discussed in our other videos to set your own limit, not the bank's limit. The bank's yes is just the start of your negotiation, not the end of your planning. Conclusion: your roadmap to the keys. Getting pre-approved is stressful, invasive, and exhausting, but it's also the most empowering step in your journey. It gives you the confidence to walk into any home and speak with the authority of someone who can actually close the deal. Your 3-step action plan. 1. Audit yourself. Look at your credit and statements through the eyes of a cynical underwriter. Find the flaws before they do. 2. Organize the Big 5 documents. Keep your W-2s, tax returns, bank statements, pay stubs, and ID in a secure digital folder today. 3. Find a strategic lender. Don't just find someone who gives you a rate. Find someone who explains the strategy and helps you navigate the traps. The Mortgage Trap is here to make sure you aren't just another statistic in the bank's ledger. We're building your financial future one step at a time. If this deep dive helped you understand the game, make sure to hit that like button and subscribe to join our community. Your support helps us keep bringing you the truth behind the curtain. Now, I want to hear from you. Which of the 4 C's do you think is the hardest to manage in today's market? Drop your thoughts or any questions in the comments below. I read every single one of them. Thanks for watching, and I'll see you next video.